CEO of Bank 21, Tyler Knott, joins us in part 2 of a series today, talking banking and finance. What does it take to get loans from his bank? How does he underwrite? What is he looking for in inflationary times in 2023 and beyond? We're going to go deep, so check out the episode right now. Welcome to part 2 of the episode with Tyler Knott. Tyler is a good friend of mine and a local banker in the industry. And if you haven't already watched it, please go back and watch the episode that Tyler and I recorded with regard to the banking collapse of SVB and Signature Bank and Credit Suisse, where Tyler really helped us get a firm understanding of that crisis and what's happening over there. But Tyler, I appreciate you coming in today. I really wanted to go, and seeing I have you here talking about this crisis, I wanted to go deep on, where you started and how you get to be CEO and owner of a bank. So give us a little background of how you grew up in banking. Sure. Because you literally grew up as a toddler inside a bank, right?
That's right. I'd walk to the bank after school, and so I had my little kiosk, if you will. So it was, our bank is 120 years old.
Wow.
And we started in 1903.
Define we. Who started the bank?
So the bank started as Farmers Bank of Beauregard in Beauregard, Missouri. That's in Carroll County. And the people that started the bank were from out of town. And then about 10 years in, my great-great-grandfather and some other farmers decided that they wanted to manage the out-of-town bank, and so they bought the bank, and so it's been in the family ever since. So I am fifth generation banker at the old Farmers Bank of Beauregard, which now we've changed the name. We're on our second name, so it went from Farmers Bank of Beauregard to Farmers Bank, now to Bank 21, and we renamed Bank 21 in the mid '90s with the upcoming century. There was a lot of farmers banks in the area, and Bank 21 sounded like a good name because it's going to be your bank for the 21st century, and really, truly, your community bank for the 21st century, because we're trying to stay true to our roots of being a community bank. We've got locations in Carrollton, Marshall, Sedalia, and Blue Springs. And we really focus on serving the needs of our local communities on the deposit side and on the loan side.
So what positions have you held at Bank 21?
I was the chief adhesive technician when the name change occurred. When I was just a little guy, I'd put stickers on envelopes because we didn't want to throw away the old Farmers Bank envelopes. So we bought all these Bank 21 stickers, and I put thousands and thousands of Bank 21 stickers on the envelopes. That's how I started, and then worked my way as from a teller to I did bookkeeping for a little while. Then started in lending, and then in 2008 I went off to law school and practiced. And then in 2013 we had the opportunity to buy a small bank in Carrollton, Missouri, First National Bank, and so I came back to the bank and basically acted as general counsel to push that merger through, and we acquired First National Bank. It was a great acquisition, increased our capital almost double, and really gave us the tools to really operate in the 21st century. Because as a small community bank, our lending limits are really governed by our capital account. And so when we have a larger capital account, we're able to have a larger legal lending limit. That means being able to serve more customers. When we were much smaller and we had $1 million lending limit, then that kind of limits the ability to help some customers. Customers will outgrow you, and we really didn't want to be outgrown.
Let's get to banking as a business. In my business, I see cash as an asset.
Yeah.
You do not see cash as an asset, correct?
That's correct in certain regards. So a bank's balance sheet is kind of the opposite of what people will think of when they think of their personal balance sheet. So your deposit account is those are your assets. That's your cash in there. For us, those are liabilities. So deposit accounts are on the liability side of the bank. On the asset side, that's our loans and some bonds. But very few for us. Other banks, as we spoke of in part one, they can have these massive bond portfolios. But that's really the essence of a bank's balance sheet is your assets are your loans, and hopefully they're community loans to various diversified group of individuals and businesses in the community. And on the deposit side, also a very diversified mix of people in the various communities that you serve.
So if lending is your core business, so as I understand it, cash is a liability, your loans are assets, and everyone wants to grow an asset column, but you've got to have the cash to be out there. It has to be corresponding. Your lending limits are constrained by your cash. So deposits are critical,
That's right.
But then you have to lend it as well. There's kind of a balance there.
There is a balance there, and I always say that we're the only business that I can think of off the top of my head where marketing is key, but for both sides. So we're marketing for liabilities. There aren't too many. I can't think of really any other business that we're going out and advertising to bring in liabilities. And we're also advertising for assets too, because we want people to come to us with their loan requests. And so it's definitely this dynamic, this scale, if you will, where you want to have a proper balance. You don't want to get too overbalanced in loans and then have your deposit base lower. Yeah. In that case, you could have a liquidity crisis. And so it's really key to properly balance those two. And in part one, I talked about that symbiotic relationship. So our loan customers are our deposit customers. Our deposit customers are our loan customers. And so that helps balance that out.
I always, every bank I talk to, I always hear that, hey, we love to have a relationship. We want to get deposits when you're asking for loans. And so why is that so critical? Why is it that is it just that really you because you need both? If you're getting something from one, you would like to get both. Every bank asks for deposit relationships when you're asking for loan.
Right. Well, I think if we look at SVB or Signature, those are key cases where they had deposits from these venture capitalists, these tech firms, but I'm not certain. I'm pretty sure that they didn't have a lot of loans to them. They had their loans in bonds. And so that means that you've got a real fickle deposit base. They can just leave any time. They don't view it as a relationship. They're viewing it as, this is just a transactional
You're
deal.
Holding my money for me.
You're holding my money for me. This is a transactional deal, and I'm going to move my money from point A to point B. Whereas when you have a relationship, and by relationship, I mean that we're making you loans, you're depositing money with us, then you can give us a call and you can say, hey, I've got these concerns, or hey, I'm doing this with my business, and what do you think? And there's a real give and take there, where we're looking out for the interests of our customers just as much as we're looking out for our own interests, because they're so intertwined.
What makes a good loan? Is it the collateral? Is it the borrower?
Yeah, I mean, every bank's a little bit different. Every bank underwrites a little bit different. But I look at the big three, really. That's the character of the borrower, the collateral, and the cash flow. And cash flow is hugely important to us. I've seen banks that make loans based on collateral primarily, and it can put a person out of business. We need to be able to tell people no. And that's actually a good thing sometimes. I remember one person specifically, customer of mine and a customer of another bank, and he came in with a business plan that I thought had all kinds of holes in it. And I told him, I said, let's let's focus on these aspects where you've got some real risk here. And he went to the other bank, and they just said, you know what, you've got plenty of collateral. Let's loan you the money. And he missed those points of risk and went completely out of business. Lost absolutely everything because of a collateral-only lender. And so I feel that it's hugely important for us to have that relationship and talk about why this isn't a good endeavor, why it is a good endeavor. And those are the three big points are cash flow, collateral, and character. Cash flow is hugely important. If in your business, you see it all the time. When you buy a house, you want to make sure that you're getting enough rent and minus expenses to pay the bank back and have a nice deposit every month.
Yeah. So let's talk about real estate. Obviously, we've done business together for so many years now, and it's been a great relationship. Why is real estate such a great piece of collateral for you?
Well, I mean, we've been talking about diversification all day, and I feel like a single-family house is intrinsically diversified. I mean, there are so many things you can do with it. You can rent it, you can sell it, you can Airbnb it, you can live in it. I mean, it itself is a very intrinsically diversified asset. And when we're looking at it, we're looking at the debt service coverage ratio of the property itself. So,
yeah, can you explain debt service coverage for those that haven't heard that?
I'd be happy to. So you take your rents, and let's go ahead and annualize those, and then you subtract out vacancy percentage, something that seems appropriate. You're going to have some vacancies occasionally, and then you're going to want to subtract out the rest of your expenses, so your taxes and your insurance and your property management fees and any other thing that might be an ongoing expense for you. And then you're going to get your net operating income. That net operating income is the numerator of this ratio, and the denominator is your annualized debt payments. So you want to see
principal and interest,
but not taxes and insurance. Some people will escrow taxes and insurance. So when you're looking at a debt payment, and it's being escrowed for taxes and insurance, you're going to want to remove that and just look at principal and interest. Annualize that, and then you want at least a 1.2 or better. And what that means in a kind of ratio speak is for every $1 of debt payments you have going out, you want at least $1.20 coming in. And even better than that, you want more than $1.20 coming in. And so that's that debt service coverage ratio. And we look at that on the property itself and then globally. And when we say globally, it's the whole picture of the borrower. So when you're coming in for a loan, you're filling out a personal financial statement, we're getting tax returns, and we're looking at maybe all the rental properties you have or all the sources of income that you have and all the debts that you have. So car loans, boat loans, things like that. And then we're doing a global debt service coverage ratio, and we're also looking for a 1.2 or greater. That's kind of the gold standard in the lending industry. And there's so many times where I hear people talking about investing and working with banks, and they don't talk a whole lot about the debt service coverage ratio. They'll talk a little bit about DTI and the DTI requirements to get a loan. Those are primarily secondary market loans. So when I say secondary market loans, these are your Freddie, Fannie conforming loans, and you have a limit there. I believe it's 10 loans, 10 financed properties before you have to look for an in-house lender or a portfolio lender. There's multiple terms that people use, and that's going to be your community bank who's going to lend on these assets. It's not going to be that long-term 30-year fixed rate mortgage. It's going to be like a 3-year balloon or a 5-year balloon, and then on a longer amortization, such as 20 years.
Yeah. Each bank has, I refer to them as just lending buckets, is probably a more apropos term, but commercial, agricultural, residential, new construction, there's probably many more, but can you describe the different buckets? Sometimes I'll go to a bank and they say, no, the single family bucket, we've got so much single family. We're full. That bucket's full. We don't want that. So, we have to go somewhere else. But talk me through a bank's perspective of how these different buckets of assets fill up and what you're looking for there.
Right. No, it's a great question. It goes back to our kind of diversification theme, which is on our asset side. We call these concentrations of credit, and it's concentrations of where we're lending. And so, when you look at 2008 and 9 and 10 at some of the bank failures there, they had heavy concentrations in construction lending and home lending, mortgages. And so it's really key for a bank to diversify those concentrations and not get too concentrated in a specific area. And so when you go to a bank and they say, oh, we've had enough single-family rentals right now, come back later, it's because they've filled up that bucket, if you will. And what it is they look at their capital account, and then they determine, how much as a percent of capital are we willing to risk.
Yeah.
On this particular segment of our lending.
You mentioned 2008. Were you getting your law degree then, or you?
I was.
Yeah, but
yes.
you were obviously involved with your parents, deeply involved
Sure.
in the bank at the time. How did Bank 21 pivot through that 2008? Were you guys caught with a bunch of bad assets? Like, what did 2008 look for you from a banker's perspective?
No, it's a really great question. We really had very few loans go bad. We had a participation that was participations are when a bank lends an amount of money, and then they split up that loan between other banks. And so we rarely buy participations anymore. We're burned on that one particular venture. But it was a development in Iowa that went bad because in 2008 the crisis happened. Then retail kind of crashed, and so these big developments, it was like a shopping mall. Just went on pause. And so that loan defaulted, and then all the participating banks gathered around a room to try to figure out, what they can get. And so we took a very small loss, but it was a loss. I think we survived swimmingly. We didn't have really any notable foreclosures. We had a very diversified mix of loans, and our loans that we had were underwritten on the basis of cash flow, and most people's cash flow during that time remained pretty good. And so it was those kind of speculative investments, a development. We had some construction loans that also went bad, but the character of the people really came into play. So I know one gentleman, he said, I'm not going to declare bankruptcy. I'm going to work through these. And so it was about 5 years later that he held onto these lots, and we put them on interest only, and he then started building on them one at a time.
Wow.
And actually worked his way through it, where a lot of people just put up their hands and said, we're not going to do this anymore. So
I think that hits to the difference between a community bank and a big national bank, and that's
right.
what I have loved working with Bank 21, is you have said yes in so many ways, not just to me, but to the clients that I've brought you. You have looked beyond and actually taken time to get on a Skype call or for an out-of-state lender to get to know that person, understanding that if they have a local LLC with centralized property management in the form of SBD housing with a company that's going to fix and flip the asset locally, and you know, like, and trust. Again, you've got the character of the property manager, you've got the collateral, which is strong. If you can get comfortable with the character of the borrower, which you took time to do, I think getting a personal experience and getting to know your borrowers is probably part of your MO, right?
Oh, it's key. I mean, the character of people, what they've been through in their lives, what their direction is moving forward. that is hugely key, because in these moments where there's panic or there's softness in the system, you want people that will stand up and do what's right, and that's key for us.
Talk to me about the law degree. How does that? I mean, did you always plan on coming back to banking? Did you consider starting a practice of something outside of that? Like, how does the law degree help you inside what you do now?
I think to run a bank these days, you almost need a law degree. I mean, the regulations that we're subject to are very intense, and we're under a microscope. And so it's very helpful. I always knew that I was going to run the bank, whether it would be just on the board level from a distance with my own practice, or being on the front lines and managing the bank as I'm doing now as CEO. So I always knew that was going to happen. That we've got no plans to sell the bank. Our goal is for the bank to be in the family for another 110 years.
That's cool.
And so that's it's setting up the right systems. One of the things that I think that you do an excellent job here of is setting up systems in place that really deliver excellence. And the way that you do that is you've got to be the CEO. You can't expect someone else to do that. I think there's a couple ways to manage, and you can manage by delegation or abdication. And abdication's where you say, well, I've hired some good people, and I really hope everything's going well. And I think you see some banking families that do that, where they just operate at the board level, and they aren't in the trenches making sure that the bank is operating with excellence. And so that for me was key once I had that epiphany that really the best way that I can move this bank forward is to be in it and building the right systems to deliver excellence.
You've scaled it too. I mean, you continue to grow, right? What are your goals for 2023 and beyond in the next 3 to 5?
Right. So we would like to get up to that $1 billion level, but slowly, organically.
Yeah.
That is really the case. My immediate goals are not financial, really. It's continuing to build the systems of excellence. And
that probably starts with the people that you're hiring to be in the bank too, right? I mean, people are at the core of what you do.
Right. It's about checklists. It's about systems. When someone comes in, we've got a checklist for, how we're serving that potential customer or customer. And it really makes it a seamless process, and continuing to build those systems, because they don't just happen.
No,
they weren't there when I came in, and so building those takes work. And so when I envision the future bank, it's a bank that just delivers excellence at all levels. So if we have a couple of tellers quit, and I've got some new hires coming in, they're delivering the exact same service that the previous people did.
Yep.
And the same with lenders. So it's a real testament to the ability to build systems and checklists and deliver what you want to deliver.
So funny. There's so many parallels to what we're going through now, trying to scale our business, right?
Yeah.
Like when we are dealing with a homeowner or someone who might be looking to sell their home, or a realtor or a wholesaler, someone that wants to have us buy their home, there's checklists and processes that our inbound lead managers need to take to make sure they deliver the same consistent experience, but that doesn't come without, again, written processes.
Exactly right. And when you're hiring someone new, you can take that person under your wing and show them the ropes without checklists, or you can have processes and checklists in place,
and training manuals, videos, and
exactly. And I think that's the right way versus the wrong way, because you can't scale that. Your time, you only have so much time in a day, and so if you're having to hands-on train every single person on every single aspect, then you're going to stay very small.
Your economic forecast, what do you see for, and I know this is a total crystal ball, but I get asked all the time, so when I've got a smart guy in the room, I'm going to ask the person, 2023, we are now on the heels of what I would call one of a historically quick uptick in interest rates. You may be, you would know more than I, but that has to be one of the quickest rising interest rate environments that we've been in at least since I've been around.
Since the 80s.
Okay,
that was another time when it rose very quickly.
So talk to me about interest rates and what you see the impact on. What should we anticipate for the interest rate environment in 2023, and then how's that going to impact the economy?
I think there's two directions that the Fed's going to go. They're going to keep on with their plan of raising interest rates until they deliver a soft recession or a soft landing, if you will. Their goal is to check inflation, and inflation is really continuing right now more than they anticipated. So they're going to keep on raising interest rates, but there's
another
also
half point, 50 basis points again.
There's a school of thought that says that considering this kind of panic mode that people are in, that they might tone that back a little bit temporarily to let the markets ease, kind of get everyone back on an even keel, and then continue their attack on inflation at a later date once this is kind of subsided. So I could see them skipping an interest rate hike in the immediate future and then beginning those again at a later date once they've kind of have put into place some additional regulations and some I call it training wheels for the bigger banks.
So your assets are loans.
Yeah.
Have you seen a drop off in lending requests with interest rates increasing?
No, we anticipated that that there would be a drop off in some particular concentrations, some particular buckets, if you will. I thought building would considerably slow down, and
do you mean new construction housing?
Construction, yeah.
Okay,
and it did for a while. There were plenty of businesses that said we're going to put a pause on this. We're going to clear out our inventory, and then we're going to see what's going on. And then in the past couple weeks, it seems like that things are starting to ramp up a little bit. We're starting to see some new requests come in. We're starting to see that there is the builders, the buyers are viewing the market as there's being a shortage of houses, and there's only one way to deliver on a shortage, and that's to build more. People are becoming accustomed to paying the higher prices. People are becoming accustomed to paying a little bit higher interest rates, and the mortgage rates are reasonable right now, considering the history of rates. So it's I think you're going to see construction to continue, albeit maybe at a reduced pace, and then business in general. I see good things in multifamily and rentals as well, because if there aren't houses to buy, there's got to be houses to rent, and apartments to rent. And
so You talked briefly about the government trying to, force us into a recession or at least curb inflation. Those could be synonymous. They may not be.
Right.
Do you think 2024 signals a recession of some kind? I mean, I feel like we're still yes, COVID was a blip on the radar. It was a massive hurdle for us to overcome, but that should have decimated industries. But the way that the government just dropped helicopter money across all of these, through the PPP money and the ERC credits and all the different things, the ways they got money to the business owners as well as the consumers. There was a lot of people that were kind of rescued through that time period. Right. So it should have been a recession. It wasn't. Do you see one coming?
I would argue that they almost engineered the inflationary environment that we're in. They threw cash at what they perceived to be a problem, and when you increase the money supply like that, inflation is inevitable. And so I think they're trying to right now backtrack on and fix their mistake, and so I do see that. At a certain point, when you increase rates so much, it's going to slow down business. It's going to slow down the economy. And so where that point is, I think it's tough to tell. But the only thing that we can do as citizens is to stay diversified, and manage the risk as appropriately as we can.
Yeah.
And that just means, doing right by your business, by your employees, by your customers, and
Staying liquid.
and trying to do the best you can for your business.
Yeah. Tyler, the main area that you and I have enjoyed a long-standing working relationship is through lending on single-family rentals.
Yeah.
Talk to me about why. I know you mentioned it in part one. I want to kind of reiterate in case someone watching didn't see that episode. But single-family rental. Why do you like single-family rentals as an asset class, and that you so freely lend on a consistent basis?
Right. Well, I think diversification is key. So it's a smaller asset for us. So a loan on a house is a smaller asset for us because it's that a house price for a rental. You tell me what's your average?
150,000.
150,000.
Yeah.
Right. So we're going to lend 75 to 80% of that. So
Yep.
it's a smaller loan. So that's when you pool a number of those loans, that's diversification over a large number of borrowers, over a large number of homes, in a large number of areas of towns and communities that we're involved in. And so that's great. And then I touched on it earlier, which is the house itself is intrinsically diversified because you can rent it, you can sell it, you can Airbnb it, you can live in it. I mean, there's so many aspects, and it's a tangible thing. I can go drive by a house and see if it's well maintained or not.
Yep.
I can tell if the gutters are falling down, or if the paint is peeling, if there's wood rot on the front. I mean, you can tell when there's trash in the yard, or if it's not being properly maintained. And then you can identify that risk and then talk to the borrower and say, hey, before we get this renewed, let's get those gutters fixed.
I'm laughing because you literally have done that to me. You drive by a house on 50th Street
Right.
and you're like, Mark, I know you're sitting in that CEO seat. Did you know that this doesn't look very good right now? And it was great because literally you were there just doing a check, and you kind of raised some issues that sometimes we have a property sit, and I had no clue that it was looking as bad as it was. And we were able to go in there, fix it, and now I'm sure you know, but it's under contract, and we got a pretty good price on it.
That's
so
great. No, that is great. And it does. It takes a team, because there's things that I see that other people don't see, and so that's the great thing about single family houses, is that it's an asset that you can go by and look at. We do all types of lending though, and we'll do equipment financing and ag lending and lending on cattle. But my personal favorite is houses, because the house isn't going to walk away or get
die
stolen
or get a disease.
Right, exactly.
Do you want to speak a little bit about the quality of borrower that we've delivered through SBD Housing? I know we've tried to focus on high income, high net worth individuals. I know you mentioned the character of the borrower. I think is it fair to say that SBD's delivered a pretty high level borrower to your business?
These are all professionals. Everyone that you've introduced me to are professionals that are goal-driven, that are career-driven individuals that are looking to invest in an active investment where they're actually taking the reins and not just saying, I'm putting my money in the stock market and going to shut my eyes and hope in 30 years that it's going to deliver me millions.
Yeah.
Your clients are looking for investments, but it's investments where you do have to put in a little bit of work.
Yeah,
and
it's done with you, right? It's like SBD is doing it with the investor.
Exactly, and it's a great asset too because it's leverageable. You hear about people buying stocks on margin. That's extremely risky. But buying a house, getting a loan on it to buy another house, not so risky because you're looking at what are we getting out of that house? You're getting cash flow from renters.
Yeah.
And the rental market's strong. And if the rental market isn't strong, then you can sell it.
Yeah, I recorded a video just a couple of nights ago that I gave to Pete. I was looking at some analysis on the MLS, and the MLS, the local multiple listing service here in Kansas City, tracks all the data for houses that have sold. And I was just looking at the inventory that we'd sold in the last 30, 60 days. I think it was like 24 houses. And about 2/3 of them had where it had sold previously before we bought it. And it was almost to a T, saying if something had sold in the year 2000 and now it was 2022, in 20 years, it had more than doubled in value.
Sure.
And I think in Kansas City, it's fairly standard for good assets and good areas that have been nicely remodeled to get that double in value from, an asset from, 99 to 2019, or from 2020 to 2020, from 2000 to 2020. We saw a lot of doubling in value consistently across the board. It seems to be a stable asset class in the Midwest.
Very much so. And not only are you, your values increasing, but you're earning all the rent in that interim period. And so it's like a very high dividend stock. You know, it's an asset that is going to appreciate likely over time, and one that's going to deliver cash returns to you.
Yeah, you hit on the four pillars. We always talk about the four pillars of real estate being the appreciation, the depreciation or tax benefits, being able to scale with leverage, and then obviously the yield, or you said dividend, the cash flow that comes off of the asset. So
exactly.
Hey, this podcast is called Mistake-Free Real Estate.
All right.
It's very much tongue in cheek, right? Because clearly there's no such thing. But the idea is that I've made all the mistakes in real estate so that you don't have to. Without mentioning any names, I know you've kind of had a couple of properties that have gone bad, and you're very hands-on owner of the bank.
Yeah.
Tell us a couple, if you want to share a story of a mistake that you've made in real estate. I know you've taken back a couple of REOs that have led to funny stories. Do you want to share with the audience a story that you've got as a mistake that you've made in real estate?
Yeah, there's plenty of them, but one that comes to mind are, and we talked about systems, and several years ago we were lending on some houses that were supposed to be flips, and the individual was taking that money and investing it elsewhere. So taking construction draws, and not putting the money into those houses.
Okay.
And so we show up one day, and lo and behold, no work has been done, and we're faced with a fully advanced loan and an asset that is not remodeled. Yeah. And so that goes back to when I talk about systems, is you can have a great lender and someone that you trust, and you're assuming that inspections are getting done, but never assume. Build those systems in place, put systems in place that we have now that for every draw must be accompanied by an inspection.
Yeah.
And you hear about me all the time.
Well, I've done hundreds of loans with you, and you still inspect the house. So credit to you that you've got the systems in place to make sure that happens.
Right. So and I believe that that you can't make rules and then not live by them yourself. And so that's when we're creating systems at the bank, then I'm following into those systems as well. So you can't rest on your laurels, if you will.
Love it. Tyler, the last question I ask everyone who comes on the show is a little bit of a fun one. As you know, I love to golf, and I love the idea of having 4 hours to really get to know somebody out on a nice day on a golf course. So my question to you is, if there were 3 people that could join you in your foursome, whether it's to play golf or if you enjoy that or not, who would you love to spend an afternoon on the golf course with? 3 people, either alive or past.
Oh boy, that is a difficult one. I would, I'm going to do a purely selfish one. My grandpa, who passed away, I'd love to have another afternoon with him. I've been getting into the history of Rome, and so Marcus Aurelius would be a really interesting figure, because he's kind of a philosophical giant, but his decision to put his son in charge after he passed away basically ended Rome. So Commodus. Yep. And then I would say I would really love to bend Lincoln's ear. I think that's probably a classic one that a lot of people mention
for sure
as a person they'd like to talk to.
No, well, it doesn't surprise me as someone who's well studied as you that you land on historical characters. I know you're a student of history and appreciate your time today. It's been wonderfully
Very
insightful, and I know there'll be a lot of people that'll be getting value out of it. So thanks so much for your time.
Thank you for having me.
For those of you that, again, want to reiterate, part one of our discussion today really talked about SVB, the banking collapse that happened here in March of 2023. And so please go back and check that one out. But we hope you enjoyed the episode today. And we will remember to like and subscribe. And if you are watching on YouTube, hit the notification bell so you can get alerts for all those upcoming episodes. Thanks so much.
You're listening to Mistake-Free Real Estate Radio, the authority in passive real estate investing. No late-night calls, no clogged drains, no tenant nightmares. Take the passive investor's approach to real estate investing and trust a turnkey professional. Learn more at mistakefreerealestate.com. Until next time, remember, you don't get rich from what you earn, you get rich from what you own.